Today is a Sunday, and according to the pro day traders, uh, time away from the market is to study, and while in the market, it is to practice what has been studied. And many in sports and other disciplines, the people who are really good at it have spent time aside from the actual work. So what I've learned at my stage of trading is this: stocks behave very similarly to a electrical pulse that are in decay. And as a electrical engineer, I realized there is a correlation between a decaying signal and the behavior of the market conditions. So if I look at this particular setup, initially there's a spike. Then that's the first wave, and then it dips, and then comes back with a second order wave. Then it comes with a third order wave, and then it slowly dissipates. That is similar to a third order waveform in electrical engineering. So if I were to plot out, if I were to add a signal here at this point, a drawing called Fibonacci retracement, and then bring it all the way down, maybe at around here, that's where the real dip is. So if I do that, then I can see it right around here. If I do it right around here, because this was a case where it actually dipped further than what its normal behavior is. So if I look at this, this gives me an idea about how I can exit. So this is very critical. I experienced in numerous trades where I would get in correctly. However, I would miss the sell point on the second wave, which is the third, which is the second high peak of this decay, waveform decay. And if I miss this, then the high peak of this is actually lower than this, so I would be missing out. And so even if I bought it here, my return will be less. And so this Fibonacci retracement gives you an idea that says, okay, so if the price recovers somewhere above 23.6% to 38.2%, somewhere around there, then on the first response from the main bounce, I need to take my profit at this point. That is the most likely scenario of how the stock will behave all the way across the day. So this, based on looking at some other stocks as well, is a prime example of a waveform that represents a significant shift in the stock price, where the behavior of the stock price behaves just like a decaying signal. And as an electrical engineer, I relate this phenomenon of human fear and greed behavior as such, where the first wave is the highest, then the second wave is going to be somewhere between 23 and 38% tile. So I'm fine tuning my exit strategy in order to maximize my gain and not have to worry about a FOMO because I sold too early. And the worst part, I would avoid the worst part about is holding and then having to sell somewhere around here.